Well, hello there again. My name's Lee Thurburn, and you're on Live Stream Lee. Thank you for joining us today. And I want to welcome you to what I think is going to be a fun and interesting program. Today, we're going to continue our conversation about how to raise funds for your business with a focus primarily on venture capital and equity capital, specifically on the venture capital channels. We'll also probably get a little bit into IPOs and private placements. This is the third in a series of conversations that we're having on the subject of funding and financing your business. And so I want to, make this both interesting and fun for you. But before I get started, I want to remind you that if you go to livestreamlee.com and click on the Join My Community link, you'll be able to create an account and gain access, and this is free, gain access to documents, spreadsheets, slide decks, and other things that I post online for the benefit of the members of the community. When you join the community, you actually get an account, which is free, on Apricot Rocket, which is maybe the most advanced business connectivity tool out there. Now, I got to say, we're small. We don't have a huge number of people on our system. But if you are looking for a way to grow your business faster, I think we can help. And so create an account, join the community, get access to the documents, and tell us about your business. What kind of services do you offer? Who's a customer for you? And then we're going to do what we can to send you leads to be able to help you gain customers and grow faster. Apricot Rocket, the Apricot Rocket networking groups we run, and Live Stream Lee are all devoted to helping small businesses grow faster so that the owners of those businesses can enjoy the benefits of a better revenue stream, more time with their family, and when they retire, get more value out of their business. And that's what we're here for. One of the issues that I think everybody confronts is getting email newsletters. Many of them you don't ask for. I am a big fan of history. I've mentioned before, I like to read historical stuff. There's a guy that sends a newsletter out that I want to tell you about. This is a free newsletter. It's a historically oriented newsletter. The guys, you see him on screen, Dan Nelson. He is a genealogist, and I'm going to tell you, he's a master storyteller. He comes up with some really great stories, plus tidbits of historical facts that you're not going to find anywhere else, unless maybe you're a genealogist. Dan sends out a newsletter every couple of weeks. I look forward to it. It comes out on Saturdays. It's always a fun read. And I always pick up some interesting historical tidbits that they're fun just to know. And so if you're a fan of history, go to livestreamlee.com, click on the Dan Nelson link, sign up for Dan's newsletter, and enjoy it. I think you will. So I also want to mention that later this week, on Friday of this week, Friday, April 16th, we're going to be interviewing a Dallas icon, a legend of business networking in Dallas, Bill Wallace. Bill Wallace started Success North Dallas close to 25 years ago now. And it has grown into the most significant and high-level networking event that exists in Dallas. He gets speakers from all over the United States, and we're going to find out how he did it. What are the secrets to his success? Because he's definitely built something that others have tried to emulate and failed. So come and listen on Friday, 3 o'clock, as we interview Bill. Find out how he's done it and what he's got in store for the future. That's Friday at 3 o'clock. So I want to go ahead now and get into the main part of our episode today. So I'm going to go ahead and launch a PowerPoint, and we're going to pick up where we left off the previous, yesterday. And that is, we're going to be talking about partners. We talked about yesterday and the day before, we talked about using your own money and friends and family money. We talked about angel investors, and we had an introduction to accredited investors, Today, I'm going to talk about partners in venture capital. So I use the word partners a little bit loosely here. I'm not talking about partners in the legal technical sense of partners in a partnership. Partners are, when you're trying to raise money, partners are basically anybody that joins you in helping you start the business, who is putting up money and participating with their time. They basically are a co-founder with you. Presuming, of course, that you founded the business, which I'm presuming you did. So one of the benefits of having partners is that, and again, this could be somebody that's technically joining your corporation that you've set up as a vice president, or maybe you're the CEO and they're the president. It doesn't matter. Somebody that puts in their time and their money and joins you to launch a business is considered a partner. And the good thing is that they bring expertise, they bring genuine commitment, and they bring money to the table. The downside, of course, is you have to share your equity with them, but you're going to have to share your equity in any kind of situation where you're trying to raise equity capital. So that's not a downside. But partners are and can be a great source of early stage capital investment, as well as a committed team member. We're going to go ahead and move on to venture capital. And there's actually, I think, a bit of a misconception as to what venture capital companies are. And a lot of people think venture capital is early stage risk capital, and that's really not the case. Venture capital companies are typically companies that want to come in later in the financing, later in the stage of development. They are looking for companies that have established a business plan that is executable and has demonstrated its executability, its ability to generate revenues. Venture capitalists like to come in and take a reasonable percentage of equity in the company in exchange for their money and their input. Venture capitalists tend to want to sit on boards. They or have a representative, maybe on the board, somebody that is in another venture capital company that they know and trust. They look for companies that have, again, established that they've got a business model that works and that they know how to generate recurring revenue and need help growing the business. They tend to put the investments through a very rigorous due diligence review process. A typical venture capital company will only actually invest in about 1% of the deals that they get. Basically, venture capital companies are formed specifically for the purpose of making investments, and they accumulate capital from investors that give them money that they turn around and add with others to make investments. Venture capitalists are professional investors. They get a lot of deals. And so out of every 100 deals that they get, typically about 90% of them will go into the circle file, the trash, because they just simply do not meet the criteria for what the venture capital fund will be interested in investing in. Many of them won't qualify because there's not enough money. They won't qualify because they are not mature enough in their thinking. They won't qualify because they are not in an industry that is of interest to the venture capital company. They won't qualify because they don't have a good management team. There's all kinds of reasons why they don't qualify. Only about 1 out of 10, about 10 out of 100 deals are seriously looked at. And out of those 10, typically only about 1 will actually be invested in. Now, when we started the conversation about raising equity capital, we talked about the credit crunch, the fact that if you're not asking for enough money, you may not be able to. It may be more difficult for you to get capital than if you are asking for a larger dollar amount. Well, venture capital companies have a tendency to generally, and they're all a little bit different, but generally they'll have a certain size fund, and they'll have that fund divided into annual investment tranches or buckets. And if, for example, if they have a $100 million fund, they'll typically have about 5 annual $20 million funds that they invest, and then they roll over about 5 years later. So out of a $20 million investment portfolio for a given year, a VC fund might plan to invest $1 to $2 million in 10 to 20 deals, somewhere in that range. So their minimum threshold might be $1 million, and their maximum threshold might be $2 million. They'll set parameters, and then they'll need to put that money to work for them. And because they are very careful, they want to make sure that that they've done their due diligence completely. And so they will tend to spend a lot of time on the due diligence, and that's an expensive and time-consuming process. And so if you don't have a large enough ask, you may not get considered simply because you don't take a big enough piece for them to justify spending the time on. And so that's one of the issues. That's part of the credit crunch sort of issue. If you look at venture capital funding from the period of 1995 to 2010, 11, 2012, there was obviously a peak in the dot-com days, but it's been fairly steady and growing at a fairly steady rate. Venture capital companies do not typically invest in seed stage investments. They do not generally like early stage investments. They generally like expansion stage investments. And so seed capital is not going to be, they're not going to be the place that you're going to go for seed capital. Now, you can go to any number of websites, and basically you can search on Google and find venture capital companies in your part of the country. Dallas has a lot of them. Fort Worth does. The East Coast, the West Coast. Any major city is going to have a significant venture capital footprint. So if you just type venture capital investor Dallas, venture capital investors Atlanta, and plug in your city name, you're going to find pretty easily a list. And if you go to their websites, they're all going to have a relatively straightforward process for you getting in touch with them and submitting your business idea, your private placement memorandum, whatever you have in the way of a business plan, and they'll have guidelines for how to submit. You definitely are, being invited by them. They want to see your deal. If they don't see your deal, they can't say no, but they also can't say yes. And so they need to be able to see your deal. They're very interested. And they're reasonably approachable. I have a few charts here that'll help you visualize where venture capital comes into the financing equation. This first chart shows the sort of the life cycle of a business, starting with concept, startup, growth, and expansion. And venture capital companies will typically not be particularly interested until a company has been able to establish some preliminary investments as well as a significant ramp up on the sales. As the ramp up on the sales occurs, the risk begins to decline. And so this is the point, if you look at this chart, about 2/3 of the way through the cycle of this development, as shown here, is where venture capital companies will come in. Grants, personal money, friends and family money, angels, those are all things that are going to be available to you to get your business up and running. But once you've demonstrated replicatability and the ability to kind of twist the dial on the marketing and grow the business faster, venture capital companies will tend to start becoming interested. Another way of looking at this is this graph that, let's see if I can make it just a little bit larger. This graphic that shows the amount of money that you're asking and the stage of your startup. So when the amount of money that you need and is small and you're in the earliest stages, you'll be looking again for grant money, personal funds, friends and family funds, seed stage investments. And then as you begin to grow, you might be able to get money from angels. Angels are certainly much more risk-oriented, much more early stage oriented than venture capital companies. Once you begin to migrate out of the very earliest and into sort of a little bit more level of maturity, and as your dollar amounts start to grow, you'll find venture capitalists will begin to be interested in you. Notice the red circle in the upper right-hand corner, mezzanine financing. We're going to come back to that, but mezzanine financing is not typically something, you may hear the term thrown around, it's not typically something that is going to be sort of early stage or early growth stage for a company. Here's another chart that gives an ever so slightly different look at the venture. Oops, I'm trying to go back up here. Here we go. Gives you a slightly different perspective. You have time to close on the vertical left side and dollar amounts on the right. When you need money relatively quickly and your dollar amounts are relatively small, friends and family as well as personal funds tend to be where you go. When you are beginning to look for a little larger dollar amount, you can start looking at angel investors, angel groups, and then venture money starts to come in a little bit later. Now, the reason I'm showing you a whole series of graphics is because they each paint a slightly different perspective. No single graphic tells the complete story. Venture capital can come in early. It occasionally does. Angel investors occasionally will cut a check the very first time that you meet with them. So the guidelines for how long it takes and the dollar amount are just general sort of representations. I really kind of like this chart because I think it gives a real good representation at the earliest levels where you need seed money. Not only is it your personal funds, but again, angel investors will often get involved at the very earliest stages. Venture capital companies sometimes will, if a company's idea, if a business idea is particularly attractive, but generally they're going to be much more interested in putting their money in as you begin to ramp up and approach break even and profitability. Once you start to achieve break even and profitability for your company and you're ramping up your growth, then you start being attractive to larger funds as well as larger financing arrangements, private equity, mezzanine financing. Now, let me mention what mezzanine financing is. Typically, mezzanine financing is a term that is identified with a company that has grown significantly and it's beginning to reach a point where it is beginning to be a financeable business or a business that could be taken into a public market. And so mezzanine financing typically applies to large brokerage institutions, financial institutions that'll step in to provide you with a significant debt capital that will allow you to be able, and equity, but debt capital in particular, that'll allow you to be able to position your financial statements so that you become attractive as a publicly traded company. So mezzanine financing is relatively late in the growth cycle when your business has achieved certain economies and efficiencies of scale. This chart shows the kind of the relative balance of venture versus angel investments. In the earliest stages, angel companies, angel investors are going to be typically responsible for about 75% of the financing. Venture capital companies, very little, couple of percent of the financing that's put into early stage, seed stage investors, businesses. Most of the rest of the money is going to have to come from friends and family and your personal funds. As you move from startup to early stage where you're proving your business model and beginning to grow and expand, then venture capital and angel investors kind of balance out. And then as you've proven your business model, you're expanding, you can then begin to look more for venture capital financing. Now, venture capitalists, because they want the risk removed, are much less motivated by 10, 20, 50, 100 times return on their money. They're looking for still a significant X, 5, 10, 20X, but they're not expecting to hit 100 or 500 X. So now nobody really expects to hit 400 or 500X, though those things do happen. But angel investors are way more risk oriented because they're expecting, when they get in at an early stage, to have a much higher probability of a big multi-factor X return on their investment. Next, let's talk about what venture capital investors look for. The very first thing, the most important thing, is management, the management team. Does the management team have strength? Do the people have the kind of credibility that would indicate that they know what they're doing and that they're capable of executing? And typically it's prior industry experience, prior experience bringing companies to an exit. Those are the kinds of things that they're looking for. Has the team actually worked together in the past? That's a big plus. It's not a requirement, but the single most important thing that all investors look at is the lead, the founders and the key people. Are they hungry? Are they motivated? Are they smart? Can they walk and chew bubble gum and calculate at the same time? I mean, they're looking for people that are motivated, highly motivated. Investors generally just want to know that you're going to work extra hours and you're going to work extra smart. What you're going to do, whatever it takes to make their money provide a great return, because you're not going to let the business fail. They're going to look for a competitive edge. They call this a competitive advantage. We've talked about this in a lot of the episodes that I've done, but there's probably nothing more important really than having a great product that the market really wants, and where you have something that's truly unique about how you deliver or what you deliver to the market. They look for an industry that is large. And by that, I mean, you're probably not going to get a venture capitalist to invest in a sandwich shop. You might get a venture capitalist to invest in a 20 or 30 sandwich shop nascent franchise that has the potential to grow nationally, but you're not going to get a venture capitalist to invest in a little sandwich shop. They're looking for a market that's big, and your local market that you serve with a sandwich shop is not big enough. So venture capitalists look for market sizes that are billions of dollars, and they especially like it when the market itself is expanding rapidly. So there's a lot of need for new offers into the market. In other words, you're not trying to cannibalize somebody else's business. They look for viable exit strategies. In other words, they look for a business that first has, again, back to the exit strategy conversation, a management team that is interested in an exit. They don't want to ride that particular business to retirement. They're looking for a business idea where there's conceivably lots of potential acquisition partners out there, where it's an attractive enough industry to where there's multiple purchasers. And then they also would love it if there was the option to take the company public. So they want to see that these are viable strategies. And then they look again at the intangibles. And the intangibles are sort of back to the competent management team question of, can you walk, talk, and chew bubble gum at the same time? In the perfect world, from an intangibles perspective, when they look at you, they'd like to see the next Steve Jobs or Elon Musk. They want to see somebody that's dynamic, full of energy, full of vision, and that can articulate the opportunity, because being able to articulate the opportunity is hugely important in terms of achieving all of the other factors, especially the viable exit strategy. So these are the things that venture capital investors typically will look for. Now, outside of the realm of venture capital itself, there's corporate venture capital. There's a lot of companies in the United States and globally that actually have incubator type funds. They make investments in small companies in their industry. It doesn't matter whether this is petroleum industry or technology industries or healthcare or any number of other industries. There's a lot of companies that will invest in smaller companies because they want to both foster innovation as well as get their fingers on opportunities where if the small companies develop technologies or business models or market niches that the bigger company can take advantage of, they want to be able to have a relationship to be able to do that. So you can actually, within your industry, go seek out the companies that offer investment partnerships and present your case to them. Corporate venture capital is certainly a viable option if you're in an industry that has those doors open. Probably the least likely form of equity financing that you're going to have access to is going to be a public IPO. And the reason is simply because it is one of the most challenging and difficult things for you to prepare a company to qualify for. A public IPO is often called a Reg A or Regulation A financing or offering. Regulation A is the regulation section in the SEC that covers public offerings. And an initial public offering, there's not a lot of them. In the next slide, we're actually going to show you the count. There's not a lot of them that happen on an annual basis. The average number kind of runs around 100 in the mid hundreds, 150 to 100 to 200. Very few companies that are not well established are able to actually achieve an IPO. Very few companies that have been around for less than 10 years and are doing less than 25 million in sales are going to be able to qualify to do an IPO. We're going to actually talk a lot more about IPOs starting tomorrow as we begin to close out this series. But the number of IPOs that occur tend to run, if you draw a regression line from 2000 through 2017, that regression line would be somewhere in the 160, 170 IPOs per year range. It's, of course, changes from year to year. The big spike back in 2000 was at the end of the dot-com era. The big low point in 2008 as it was a result of the Great Recession that occurred in the 2007, 8, and 9 timeframe. And otherwise, generally speaking, the number of IPOs is pretty much a direct reflection of the enthusiasm of the stock market in general. Here, and now this is a IPO count by number. Here is information based upon the billions of dollars raised in IPOs. You can see a big spike in 2000, and then another spike actually in 2020. As early in 2020, we had quite a bit going on. Now, this is actually a projection of what was predicted for 2020. The numbers are not, I can't find or wasn't able to find them for 2020 yet because we're still just not quite, don't have that information readily available. But the point is that we were seeing a strong economy up until the point in time of COVID. So the number of IPOs, generally speaking, has been relatively strong, probably in the, I'm going to draw a regression line quickly in my mind, $35 to $40 billion a year in IPOs, which is a generally fairly strong market. A successful IPO candidate will have consistently high growth, be in a scalable industry. They'll have a strong record of earnings. They'll have 3 to 5 years of audited financial statements, and that's a big deal because audited financial statements are expensive. So you have to have a pretty strong company to be able to justify that expense. You have to be in a rapidly growing industry with a strong, solid position. The average company that does an IPO has been in business for 10 years. You need a sound, solid management team. When I took FlashNet through the public offering, there was about a 6-month time frame as we were doing the run-up to the IPO, where we really relied heavily on our second tier of management to be able to run the company, because our senior management team was so involved in the planning and meetings and understanding the process with attorneys and accountants and investment bankers. It takes a lot of time away from running the company. So you have to have a solid team of people to be able to run the company. So those are some general thoughts. There are advantages of being able to do an IPO. You can raise large amounts of capital. You certainly get a big bump to your corporate image. You have the help of attracting and retaining quality employees because you have stock that you can give them. Plus, it's a big branding event for your company. You get to list on the stock exchange. You can use your stock to do acquisitions of other companies. There are a lot of positives. There are also some negatives. First, as a founder, you become diluted because you typically sell a lot of stock to a big block of stock through the public markets. So you have some diminishment of control, though the reality is control is a function more of your ability to generate a positive return for your investors than it is how much stock that you actually own. You do certainly receive a loss of privacy as a founder or chief officer in a publicly traded company. You receive a lot more scrutiny, so your actions are much more visible, and TMZ is much more likely to pay attention to you than they ever were before. You have, of course, reporting requirements and filing expenses. You have accountability to shareholders. You have to do you have to answer to the stock analysts on a quarterly basis. There's a lot of pressure related to running a publicly traded company, and you can't always get your liquidity that you'd like to be able to receive, because as one of the senior executives, you're under scrutiny as to how many shares and whether you're selling stock or not, and how many shares, and the fact that you decide to sell some shares could have a depressive effect on the value of the stock, because nobody wants to see the founders selling shares because they're all wondering, what do they know that we don't know, right? So there's all kinds of issues that can potentially be disadvantages of going public. We're actually going to stop here, and we're going to pick back up at this point tomorrow, and then hopefully conclude our conversation about funding and financing. But we're going to finish up our conversation on the disadvantages of going public when we conclude tomorrow. I do want to add to stream. Okay, turn off. There we go. I lost myself. So I do want to say that there are a lot of complexities to running a business. And one of the biggest complexities is trying to figure out what you don't know and being prepared for it. And as a small business owner, it is critically important that you surround yourself with people that you trust. And there's a guy named Carlos Cantu that I want to introduce you to. Carlos is a risk management expert, a commercial risk management expert. He's a commercial insurance broker with TWFG, and I have never met anybody that's more knowledgeable about commercial risks than Carlos. I love calling Carlos up and talking to him about ideas, because he's a savvy guy that understands not only business, but in particular risk. He's seen things happen to businesses that you haven't seen. And as a result, because this is his area of specialization, he's able to help you predict or prepare for things that you don't want to have to confront. But if you do, you'll be glad you have Carlos in your corner to help you mitigate those risks. Go to livestreamly.com. When you click on, when you create your membership account, while you're there, click on the Carlos Cantu button over on the right-hand side and connect up with Carlos. Learn a little bit more about him, give him a call, or ask him to give you a call. You need somebody like Carlos in your corner, and he's a great guy, and you'll be glad I made this introduction. All right. livestreamly.com. Be sure to go there. We've gone over on our conversation today, but I didn't want to jump out in the middle of talking about the IPO. And again, we'll pick that up tomorrow when we conclude this series. Thank you for joining me today, and I'll look forward to seeing you tomorrow. And be sure and come back on Friday to hear the interview with Bill Wallace. Bye now.